Hello everyone. In this video, let's understand the difference between mutual fund and PPF, and let's also try to understand which one is a better investment option with the real life example of LIC. So we have SIP mutual fund, and this is for the 5-year period, and total return is 42.5%. This we have for PPF, the Public Provident Fund, and we have taken the investment for again for 5 years, same period, same amount, and annual rate of interest we assume that 7.10%. That's the latest annual return percentage, and we have calculated the return percentage. So let's understand this calculation in detail. We have the entire table here. Let's go through in this detail. And also we have this differences between PPF and the mutual fund. So before we go through these differences, first let's go back to the calculation and to understand how it is calculated. Let's start with the SIP mutual fund, and this is for total of 60 months or for 5 years. So you can see here 60 months, 60 count. So that is for 60 months for 5 years. And each month, if a person would have invested like 10,000 starting from Jan 2018, the person would have earned around 42.5% return, and this return is before the taxable income. And then let's see, I have taken the investment amount for each month what we have invested for 10,000, and then we have the NAV purchase value. To understand NAV, that is a net asset value. To understand more on NAV, I have created a separate video. You can go through that. This is the purchase price. To understand what was the purchase price for each month, we need to go to the portal where we have this SIP calculation. In this under mutual fund, I select LIC. Let me scroll down, LIC mutual fund, and then let me select scheme as LIC direct plan, then investment amount of 10,000, and this for monthly, and start date is 2018 1 and end date is 31st December 22. And let's calculate. So you have the details of investment amount and also the purchase price. This is the NAV or the purchase price each month. By end of the month, beginning of the month, what is the NAV value? So same thing I have taken from the portal what we have. And let me go back to the tracker. So that's the same thing I have captured here. And then you have the unit price. To calculate unit price is very simple. The total investment amount divided by NAV or purchase price, you get the unit price. And same thing, I just copy this and extend the formula until the last row. So this you will get the unit purchase, number of unit purchased. So now we also need to, assuming that on 31st December we withdrew this mutual fund amount, and NAV as on 30th December, again you can go to the portal. You can see here on 31st December the NAV, sorry, on 30th December the NAV value was 17.104770. The same thing I have taken here. And total unit purchase, this is something which we have here. So what I did was I just used the sum function SUM, and then I just took from Jan 2018 until December 22 and press enter. I get this total unit purchase, and then total investment value will be NAV value as on December multiplied by total unit purchase. Press enter, you get the total investment value. And total deposit is like each month we are investing of 10,000, and for end of 5 years, that is 60 months, the investment value will be 6 lakh. This is again, I just use the sum function, sum, starting from Jan 2018 until December 22. Press enter, you get the total deposit amount. Then return value is again simple, the total investment value minus the total deposit, you get the return value. And to calculate return percentage is equal to the return value divided by the total deposit, press enter, you get the 42.5%. And please note that this is a pre-tax return, because mutual fund you also have you need to pay the uh, income tax on this profit. So now you understand the SIP mutual fund calculation. So let's go to the PPF, that is Public Provident Fund calculation. So assuming that the monthly deposit is again it's the same thing, 10,000. Annual rate of interest is 7.10. This is the latest percentage, but again it's gets revised every quarterly. But yeah, I have taken the same interest rate. It could be there is some variation, but I assume the same percent rate. And then you have the closing balance. So let's look to understand how it works is like first year, you have 5 years here, 1, 2, 3, 4, 5, and then you have the opening balance because the PPF interest will be paid on the end of the year. It is annually paid. The interest is calculated on or interest is calculated annually. So whatever the balance you have, sorry, whatever the balance you have end of the year, on that the interest will be calculated. So and that is the reason I have this as like I have taken this 10,000 monthly deposit multiplied by H6 is number of years multiplied by, and then you have 12, that is 12 months. Press enter. I have 1,20,000 beginning of the year, and then interest earned. It is very simple. Uh, Opening period, that is 1,20,000 multiplied by annual rate of return. Press enter, and then the closing will be whatever we have opening plus interest earned. For the next year, the opening balance will be whatever we had the closing balance for the previous month plus again K8, that is K8 is like 10,000 per month multiplied by 12. So you have this opening balance for the next year, and then the interest will be captured, the interest will be uh, calculated based on the opening balance, and then the closing balance is opening balance plus interest earned. Likewise, we did for all the years. By end of 5 years, your total closing balance is 7,40,561. Now that is how the closing balance is calculated, and total deposit again it's 60,000, sorry, 6 lakhs. The reason is like you have this monthly investment of 10,000 multiplied by 60 months, that is 6 lakhs. And then return value will be whatever the closing balance minus total deposit, press enter, sorry, I made a mistake, is equal to whatever the closing balance minus the total deposit, you have 1,40,000 is the return value. To calculate the return percentage, similar like 1,40,000 divided by total deposit, you have 23.43%. And this return, whatever we have in PPF, it's absolutely tax free. So this we can assume that's a final return percentage, whereas in SIP, it is a pre-tax percentage. So you can see there is a difference, huge difference in terms of return, where in PPF you have 23%, whereas in SIP it is 42.5%. However, again, it's depend what kind of investment, how you want to invest, and whether you want to take risk. Because generally mutual fund you will have more risk. Here it is no risk, because here in LIC for 5 years the stock has done really good, and that is the reason you see good return. But in case if you take the same other mutual fund, probably for the same period it would have been less. In that way, the return would have been less. So now you understood the basic of how to calculate the returns. Then now let's understand the basic differences between mutual fund and PPF. So for PPF, you have fixed return 7.5% for a Q4 for year 22 and 23. So this percentage can get revised every quarterly by Government of India. Whereas for market, for mutual fund, it's totally depend on market. If market perform well, then you might have a higher return. Otherwise, you might have very low return. Generally, higher return possible when the funds are kept it for a long term. Investment amount in PPF minimum is 500 and maximum is 1.5 lakhs per annum. Whereas for sorry, whereas for mutual fund minimum is 500 per month and there is no maximum limit. Investment tenure, 15 years minimum and extendable in block for 5 years. So you have the investment tenure of 15 years minimum, whereas for mutual fund can be low as 6 months or high as 20 years. Lock-in period is 15 years. There is no lock-in period for mutual fund. Investment risk, since it is gone by government, it is completely secure. Whereas mutual fund, it's a risky, since it's based on the market performance. Sometimes you might get good return, sometimes you may not get any return. Tax benefit, PPF is exempt for everything. When you have this, when you invest in PPF, you get the tax benefit, and even whatever you earn or interest earned on this is completely tax free. Whereas SIP, it's a dependent type of mutual fund. Only for ELSS you have tax eligible. Otherwise, most of the stocks are taxable. Liquidity very low in PPF because you cannot withdraw, and there are some exception like on seventh financial year you have this withdraw period open, whereas in mutual fund high it is very high, investment can be redeemed at any point of time. So these are basic differences between mutual fund and PPF, and I hope you understood the difference, you understood how to calculate the return. So again, it's all depend like what kind of investment you want to do, whether you want to take more risk. In that case, SIP is better option compared to PPF, and or if you want to be more secure, you want to be uh, ensure that the return is permanent and your fund is secure, and you no need to have more liquidity. In that case, PPF is the better option. So I hope this video is useful, and if you like this video, please click on like button, do subscribe to my channel, and please note that I am not endorsing LIC. I just took an example just to explain you. Thank you.